Hey, how you doing, econ students? This is Jacob Clifford. I am so excited you're joining me here for Macroeconomics Unit 4. Unit 3 was things started getting hard with aggregate demand and the multipliers. The great news here is we're doing multipliers again, except it's the money multiplier, not the spending multiplier from the previous unit. This is going to be awesome because we're going to practice the key concepts. Remember, these videos are designed to help you practice this stuff, not really to actually learn it. Do me a favor right now, let me know in the chat if you can hear me, if the audio is working fine. I'll jump in there every once in a while. Maybe towards the end you can ask me some questions. But first of all, I want to say thank you so much for being in my YouTube channel. I know things are crazy right now in 2020 with COVID-19, but I'm here to help you guys learn. Make sure you get the worksheet that we're going to be using today. You can start right now if you haven't already done so. Start taking a look at that, doing some of those calculations. You can see once you get in there, I'm not really focusing up on the graphs. Inside the Ultimate Review Packet, where you got that worksheet, first of all, go get the Ultimate Review Packet. It's awesome. It's totally going to help you learn. It's got exclusive videos. It's got the study guides. The study guides are essential, and that includes a lot of the graphing. So I'm not going to do that much graphing today as much as I'm doing more kind of calculation practice and making sure you understand the big concepts and big ideas. It says my audio is good. A couple other things I want to mention. For this entire month of April, I've been doing practice things for you guys. For microeconomics is on Monday, macroeconomics is on Wednesday, today, and then Fridays is case studies. Be here this Friday for the case studies. Case study is the applied application side of all this economics concepts you're learning. It's going to be awesome. Also, if you haven't seen this, the Ultimate Review Packet, there are more of these in other subject areas. So for AP Government, there's an Ultimate Review Packet for that. It has videos. I work with this guy named Steve. They're awesome. I also have one Ultimate Review Packet for AP Human Geography, AP World, AP Calculus, both AB and BC. So this is what pays the bills. Sorry for the commercial here, but if you like my videos and you appreciate this stuff, and you like all of the stuff I'm doing to help you learn, get the Ultimate Review Packet. It's totally going to help you learn and rock your AP exams and your college finals and everything else you need to do for economics. Let's jump into the unit here. So first thing, take a look right here. I'm using the AP Economics curriculum here. This is Unit 4, the financial sector. There are some things in here that feel like social science, things I'm not really going to cover, that you want to watch the summary video, the Unit 4 summary video, to kind of get an overview of all this stuff. For here, today I'm mostly talking about practice, but things like, the three functions of money, the ideas of that, or kind of definition questions. I'm not going to cover much of that stuff in this video unless you want me to in the chats, but for the most part, I'm going to focus more on the calculation side of things. We'll be hitting all the big concepts here. We'll be talking about, nominal and real interest rates. I'll mention something about bond prices towards the end. We're going to be talking about bank balance sheets. Like, that's the one that I think a lot of students get confused on. So we'll do some bank balance sheets practice. We'll talk about the money market, monetary policy, and then loanable funds. And then we'll finish off with a practice for response. All of that information we're doing right here is in the practice sheet for Unit 4. So make sure you have that thing printed out. Also keep in mind, like I said a second ago, that I have several exclusive videos like this one that are inside the Ultimate Review Packet. So if you need more help for bank balance sheets, you watch this video and basically I just give you a ton of practice. Like, okay, try this, and then I give you the answers. So the only way really to learn a lot of macroeconomics is just to practice. That's seriously, when you learn like comparative advantage, you don't just intuitively get it. You got to practice and then see all the different kind of questions people could ask you. Same thing for bank balance sheets. It's one of those things you got to practice, and watch out for the wording. You'll see what I mean when we do some practice right now. So anyways, take a look at my videos. This one's in the Ultimate Review Packet. I got other ones here. They're here on YouTube. If you haven't subscribed, please subscribe and hit that like button. You might as well do that right now because you know you're going to like the video because this is awesome. All right, so that said, let's jump straight into the actual practice sheet. I'm going to have your chat open, so every once in a while I'll take a look at it. One thing I do want to mention here super quick, and I promise I'll jump straight into it in a second. If you're a teacher, first of all, thank you so much for telling your students about my YouTube channel. I'm here to help you learn. I am your complement, not a substitute. And if you want these resources, please don't give this worksheet, this practice sheet to your students in future years. You can give it this year if you want to your students as an assignment, but please don't give this. In fact, if you're a student, tell your teacher, be like, hey, can you make this assignment? Because you're going to get this thing done today, right now. So ask your teacher to make this an assignment for you for this year. But I'm just making these available because of COVID-19. If you're a teacher and you want more of my resources, email me and I can tell you more about these different worksheets I have for AP Economics and regular economics. I've got tons of stuff for you. So that all said, let's just jump straight into it. All right, here we go. So we're talking about Unit 4, the financial sector. Like I said, I have your chat up, so I'll take a look every once in a while, see what you're saying. For the most part, we're going to practice, then I'll see how you did, and then I'll ask you some questions as we jump into it. All right, here we go. The first thing you got to understand, remember in macroeconomics, there's a certain equations you've got to know. You just got to memorize. Back in Unit 2, in fact, we actually started making an equation list. In Unit 2, it was things like the labor force participation rate, the unemployment rate, how to calculate those things. We talked about real and nominal wages back then. We talked about GDP deflator, CPI. These are all concepts we learned. In the last unit, Unit 3, we talked about the spending multiplier. The idea of, when one person spends, becomes somebody else's income, that gets multiplied in the economy. And there's also the tax multiplier, which was one less. The same idea is here. We're going to talk about the multiplier. And another idea we're going back to is the idea of nominal and real, except this one has to do with interest rates. And if you paid attention in the Unit 2 practice video, it's the same idea. Just remember the equation that the nominal interest rate equals the real interest rate plus expected inflation. I'm not sure if I'm writing it the right way. I'll probably write it the other way. Sorry. You can rewrite it and just, solve for X other ways. So let's do real. Real equals the nominal minus expected inflation. So this is the equation that you need to know for the real interest rate. If I want to know what the real interest rate is, I take the nominal interest rate, what people, charge for a loan, subtract out the inflation, and that gives me the real. And the reason why I'm saying expected inflation is because inflation can change, right? You don't know what the real interest rate is until after inflation occurs, right? You think it's going to be 2%, but if it ends up being 5%, that would adjust the real interest rate. Now, it'll make more sense once we practice. So here's 3 of them. Notice the way I wrote these questions is I'm asking you to solve for different things. The AP test, your final, your college final, all those things will do the same thing. They'll ask you for the real, the nominal, or the expected rate of inflation, and they'll give you the other 2. So if you understand this equation, you can move things around. Okay, assume the nominal interest rate is 7% and inflation is 3%. How much is the real interest rate? You throw that into here. One of the things I want to point out really quickly is the AP test, if you're an AP student, is going to ask you to show your work. So you know the answer is 4%, right? And you understand that concept. But the more importantly, nowadays, I think the AP test is really pushing towards show your work or you get no points. So you write 4%, you get no points. And the reason why is because, and it's stupid because you got 4% for a reason. I guess they want to make sure that people aren't like looking over other people's shoulders, or in this case, if they're doing it online. So it's 7% nominal interest rate minus that 3% inflation. That gave you that. And first of all, this is an important concept. Yes, you're trying to pass a test, but it's also important to understand the idea of this concept and why inflation erodes the nominal interest rate. If you lend out money to somebody, that's great. Oh, I'm lending out money, except inflation can erode that. It'll make more sense with the second question. Assume the real interest rate is -2. Wait a second, how can you have a -2? Well, remember, this is the real interest rate, and the inflation rate was 5%. What is the nominal? Well, the nominal has got to be 3%. In other words, a 3%, I lend the money out to you at 3%, but because of inflation is 5%, the actual amount of money I get back in terms of purchasing power is -2%, right? So that concept, equation-wise, you put -2% plus 5% would be the appropriate equation for this concept. So you understand, you're just resolving in this case for the nominal. So you do this, you subtract nominal on both sides. I guess you add the inflation to both sides, so you get the idea. So I'm not going to bother doing the algebra for you, but you understand the idea. You add expected inflation, so expected inflation plus the real equals the nominal. I think you understand the idea, so I'm going to move on. What I am going to point out, though, one more time, is notice this person would never have given the loan if they knew the inflation rate was 5%. So let's make sure we understand this concept here. If the inflation rate was 5%, you're darn right I'm going to charge you more than 3% nominal interest rate, right? If I know the inflation is 5%. But if I don't know, if I'm expecting it to be 1% and then it goes up to 5%, that's a problem. Remember back in Unit 2, we talked about who wins and loses from unexpected inflation. This numerically helps you understand the idea. The people who win from unexpected inflation are borrowers, and people who lose are lenders. Lenders are worse off when inflation is higher than what they expected. And this kind of proves that concept. Let's keep going. Assume the real interest rate is 4% and the nominal interest rate was 7%. What is the expected inflation? This must be, what is this, 3%? Yep. And the idea here, and it just logically it makes sense, if the nominal interest rate was 7, but you only got back, if you lend out money, 4% return, then what happened to that 3%? Well, it got eroded by inflation. There you go, that's inflation. So as long as you understand the equation, you can do the calculations every single time. You're gonna see these in different forms on your test, multiple choice. You're gonna see them in free responses. Just feel comfortable with that concept in your class. Okay, I'm switching gears. This idea here, first of all, let me know how you did out of 3. So first thing right now in the chat, hit 3 out of 3, 2 out of 3, 1 out of 3, 0 out of 3. And the reason that's gonna help me know what you know and don't know. So by the end of this video, I can go back if you want me to, but make sure, and forgive my horrible, crappy handwriting, we're gonna switch gears. Right now, like I said, let me know how you did. Let's go switch gears and talk about a bank balance sheet. Now, I've made so many videos talk about this, and like I said, and I used to tell my students this too, it's all about practice. There's no other way to learn this. You can conceptually understand it. Okay, there's liabilities, there's assets, and here's what these things are. Here's the definition of these things. You really don't get it until you start, seeing questions like this. This is gonna prove whether you know or don't know this whole idea of bank balance sheets. Okay, the answers are coming in. People said 3 out of 3, 3 out of 3. You guys are all super strong and smart. Okay, now that you got it, let's move on to bank balance sheets. Understand, liabilities are things you owe. Assets are things that you own. This is talking about the bank. It has $20,000 have come in from depositors. People have come in and said, hey, hold my money for me. And they're putting it in the bank for $20,000. Yeah, you guys did awesome. You guys did awesome for that last section. So we're moving on. Required reserves. This is the assets. So here's what they've done with those, that $20,000. The bank has $2,000 in required reserves. It is holding no excess reserves. It's loaned out $7,000. And they've bought some government securities that right now we don't know how much that actually is. So let's start doing some calculations. Let's do it. Calculate the total amount the government security at this bank owns. The answer is $11,000. Now, like I said before, it's important to understand how you got these answers. So on the AP test, particularly this year, make sure you feel comfortable totally explaining things and fully explain it. Don't be like 11,000 because it has to equal 20. Like that's pretty vague. So make sure it's really clear, particularly this year. It is true, it has to equal 20. Notice both sides have to equal 20. This is called a bank balance sheet. Whatever on this side has to equal this side. So they did something with the $20,000. 2 is in required, 7 is customer loans. That means the other 11 has to go to this government security. So that's why it's 11. I'm not gonna bother explaining that out. Just understand that you need to be able to explain that out. So one more time, this has to add up to 20 and this, because this one adds up to 20. Let's keep moving. Calculate the required reserve ratio. Explain how you got your answer. All right, here we go. Of this $20,000, required reserves is $2,000, and the question is asking, well, how much is $2,000 of $20,000? This is 10%. Or you can put 0.1, I guess, as a potential answer. Usually I don't care either way, but understand this bank is required to hold 10%. $2,000 for the explanation is 10% of deposits of $20,000. Sometimes, especially if you really understand this stuff, like explaining almost becomes like what do you mean I have to explain? Like I just get it. But fully explain your thought. In fact, you can over explain. You can't get points off for having wrong explanations as long as you don't talk yourself out of the right answer. But what you do understand is $20,000 of this, they're holding $2,000. That must mean 10% is required reserves. We're gonna need that number. So I'm gonna write this up here big. 10% is required reserves. Suppose an individual deposits $10,000 of cash into her checking account. Let me take a step back here. Your professor, your teacher, the AP tests are all gonna ask similar questions. They're either gonna have someone come into the bank and deposit money, or they're gonna withdraw money, or the Fed's gonna buy bonds, or something's gonna happen. It's almost always the same question. So if you understand there's a difference between when someone deposits money and later on when the government buys bonds, it's not gonna be necessarily the same numbers. I'm just warning you ahead of time to know this, because the thing is, once you've been doing this a long time like me, you start realizing what they're asking. So now, I'm trying to get you ready for a test. And so when you see questions like, yeah, okay, I've seen this sort of question before. Here we go. If the person deposits $10,000 of cash in the checking account, what is the immediate effect on cash deposits on M1 measure of money supply? Explain. there is no change. Now, this is more of a definition idea to understand that the M1 money supply includes both money that is cash, right? So the money that's in currency, and checkable deposits or demand deposits. This idea that, the money in your pocket is part of the money supply, and the money that's in your checking account is part of the money supply. And the reason why, so we understand this idea, is that you can use it to buy things, right? Money, M1 money is something that you could today, right now, go down to your local pizza restaurant and, put down on the table and they'll give you a pizza. So that's important to understand, and I kind of skipped that in the very beginning. In the very beginning of this unit, you talk about assets, and you understand this idea, what is an asset? An asset is something that has value, and a liquid asset, like, money, is something you can turn around and go spend, and someone will give you something. So I can go to the pizza restaurant and give them cash, they'll give me a pizza. I can write a check, and they'll give me a pizza. I couldn't, I own a home, I can't, go down there and quickly convert my house into something that they'll take for the pizza. Or your phone. Your phone is an asset. Like, you own a phone, which is good, but that's not necessarily an asset, because you really can't just say, here's my phone, can I have a pizza, please? So understand this idea of assets. That's a general concept that you should understand. And the idea of liquidity is how easy an asset can be used to purchase something. Okay, so no change. And the reason why, I guess the one way of saying is cash and checkable deposits are M1. I know I have the worst handwriting. Now, before you start complaining, just listen to the words of my mouth. Yeah, don't worry so much about the writing and that part. So I apologize for my horrible writing. Okay, that said, you understand this concept that when people put money from their pocket into the bank, the money supply has not changed. What is the dollar value of the bank's required reserves after the $10,000 cash deposits? Now, I want to know the required reserves. Now, I know you know the right answer. First of all, the right answer is going to be 3,000, right? And the reason why, because it says explain, is it is the $2,000 original plus another $1,000 from the cash deposit. Now, this is actually stay with me here. This is where things start becoming a problem for many students. Is not the concept, it's the wording. If you haven't seen this yet, in an AP Econ class or college Econ class, it's not like the concepts you're confused about, it's the wording of the question. You're like, oh, wait a second. So what you might see in this, watch this. If this question said this, if it said, what is the change in the bank reserves after the $10,000 cash deposit? That's a different question. Then the answer would be 1,000. That would be the change. It went from, 2,000 to 3,000. That's a change of 1,000. So that's how much the required reserves increased by. And it sounds exactly the same. Look at the two questions. What is the dollar value of the bank's required reserves? What's the change in the dollar value of the bank's required reserves? It sounds like the same question, totally different question with totally different answers because the way it's worded. The change says, how much did it go up by? This is asking for the total. The total is 3,000. What is the dollar value of the bank's excess reserves immediately after $10,000 cash deposits? This must be the leftover $9,000 of excess reserves. I'm not going to bother writing that out. But you understand, it's $9,000 because $1,000, remember, back up. Of this $10,000, they hold 10%, so that's added to required reserves. The other $9,000 is excess reserves. The bank can loan this out. What do you want me to write? The dollar value, how do I want to explain this? The bank must hold 10%. And can loan 90% out. And I'd further explain that with another sentence and say that 90% of 10,000 is $9,000, which is their excess reserve. Something like that, I guess I'd say, to add to it. I'm running out of room here. All right, number 9, calculate the maximum increase in the money supply as a result of the $10,000 deposit. Show your work. This is where we start adding in the idea of the multiplier. I'm going to write it down here. Understand the money multiplier is 1 over the reserve requirement. That equation right there is a key equation. You're going to use it over and over again here in this unit. Notice it's very similar, but not the same, as the one we did in the last unit, which was 1 over the marginal propensity to save. This is the spending multiplier. I'm writing it on 2 different sides of the paper so you understand that this is from unit 3, this is when there's spending. So the government spends the 1 over how much people save gets, that initial spending gets multiplied by. This is a completely different concept, the spending multiplier. This one is kind of similar because it's the same idea, except this is the idea of how much banks have to save. So instead of people saving, this is the bank saving. So people deposit money, the bank saves a certain portion by law, loans the rest out, another bank gets that money, does the same thing, and it gets multiplied over and over again. Money multiplier, spending multiplier. Let's go use this money multiplier. Like you saw in the Unit 3 practice video, there's only certain requirement reserves they give you. They won't give you like, the required reserve ratio is 2.387. They won't do that. This can be a whole number. It's easy to calculate. So in this case, it's 1 over 0.1, which is 10. 10 is the multiplier. Anything, oh, you didn't see that. Anything that gets added to the economy gets multiplied by 10. Now, that said, you're tempted, ever so tempted to go, well, it's a $10,000 deposit times the multiplier that I just said was 10. So the answer must be 100,000. No, absolutely not. Because that $10,000 that was deposited, that wasn't all new money. Only the new money created was this $9,000 original excess reserves that could be loaned out. So the right answer is $90,000. I can see in the chat you guys are all on top of it. Great, that's awesome. $90,000 is the maximum increase in the money supply that can occur because this $9,000 gets multiplied times that multiplier, not the total amount that was deposited in the first place. So $9,000, and show your work, you would say the $9,000 of excess reserves times, or you can say the initial loan, times the multiplier of 10. Then you explain how you actually got that multiplier of 10 and you understand that concept. Okay, because it seems like you guys are getting it, which is awesome. Let's go on and move on to here. This is more kind of a social sciencey question, definition thing, more than a calculation. What are two different behaviors that could prevent the money supply from increasing by the maximum amount? In other words, we're saying the maximum increase could be 90,000, but let's say it was only 50,000 or 20,000. What could have caused that to happen? There's multiple different factors. What are they? Let me know in the comments if you already know what those things are. First one, there's multiple things, is that the bank might not lend it all out, might hold some, bank holds some excess reserves. That's one thing. So in other words, we assume banks lend all the money out. In fact, most of the free response questions you'll see, it says, assume this bank lends out all the money. And that's a good assumption for doing these calculations, but it's not very realistic, right? A lot of times banks will hold a certain amount in excess reserves, depends on what's happening in the market. Another reason why is people, me and you, might not deposit all that money. Into banks. So the assumption here is that when you take out a loan, you go spend that money, the person who gets that money turns around, takes all that money and puts it into another bank. If people hold cash, in their house or, for some reason they're put it on their mattress, then that obviously wouldn't be working. Other people wrote here, people don't spend that money. That could be another factor. Most people I think some people are focusing on the spending multiplier. Let's not focus on that. We're talking about things that are going to affect the banks. So, all right, so banks hold some excess reserves. You understand those are two possible answers. We're moving, now notice, in question 11, we're switching gears. It says, assume instead. If you see that on your test or your free response, assume instead means ignore all the other crap, and let's just focus on this. Assume instead the government buys $10,000 of securities. Please notice it's the same amount as before. I wrote that, so just to clarify this concept, the government's coming in and buying $10,000 of securities. Okay? Remember, had 11,000. The bank itself already owned 11,000 of them. So these are government securities. These are bonds. They were issued by the government. The government's coming back and saying, we're going to buy those suckers back. So what happens? Well, I want you to understand a couple things. First of all, what is the immediate effect? So slow down here. What is the immediate effect on the M1 money supply? The answer is no change. Now, this is, of all the things I have in this section, this is probably the one that's going to be most confusing for many students, only because there's a nuance here. This increases the monetary base. The monetary base, not the money supply. Okay. Now, I'm not sure if your professor or teacher spent some time talking about this, but this idea of the monetary base is the amount of money that's held in reserves. So the money that's held in reserves and cash and currency, that doesn't count as part of the money supply. The money supply, the currency does. So let's just focus on money and reserves. These reserves do not count as the money supply. So this is not part of the money supply at all. So the idea is this. Remember, we said earlier that this was 11,000. It'll make more sense visually when you see it. So we already did the calculation. This is 11,000. Government comes and says, listen, we're going to buy those back. So now this goes down to $1,000, right? That means now this becomes $10,000 of excess reserves. Now the bank, and this is the idea of monetary policy, the bank now can loan out more money, right? Because they don't have their assets tied up in bonds. The government bought those bonds back. And so now they can lend out more money, which is the idea of why monetary policy tries to stimulate the economy. Giving banks more money, they can lend out more money, lowers interest rates. We'll learn that concept in a second. But understand this idea that this $10,000 initially is not an increase in the money supply. We don't have more money out there. This is just money that are in reserves. So just understand for now that this is going to affect the monetary base, not the money supply. All right, I'm going to keep going. Calculate the maximum increase in money supply when the government buys those $10,000 bonds securities. Now, since they can loan out $10,000, right, that whole $10,000 can be lent out. And when it does get lent out, that will become $100,000 is the maximum increase in the money supply, because this is the $10,000 times the multiplier of 10, which we already calculated a few minutes ago, multiplier of 10. Now, if you get this concept, you understand the difference between these two. This is what I'm trying to get at here with these questions. Notice this one was an increase of 90,000. This one is an increase of 100,000. This one was because someone deposited money that was already in the money supply, right? So they gave the bank some money. The only new money created was the initial $9,000 that could be loaned out of that money that was deposited. In this case, when the government bought those $10,000 of reserves, all of that money can be lent out, total of it, done. Will the demand deposits for this bank initially increase, decrease, or stay the same? Again, this is where things start getting tricky. It all depends on the question. So if I were to say, will demand deposits for this bank increase, decrease, or stay the same, the answer would be increase. But that word initially is key, right? And this is why I'm telling you, it's all about the wording. It's just really watch out for the wording on these questions. The initial change, so when this takes place, nothing happens to demand deposits. $20,000 is still the amount of money, so no change. No change. There's no increase in deposits. No increase in deposits by customers. In other words, there's nobody who showed up and deposited money into their bank, right? This is all happening on the asset side. It was just changing, what this bank actually owned. So there's no change over here. But when this money does get lent out, if this money gets lent out, eventually someone's going to spend it. That person's going to put it into a bank, maybe this bank, and that will increase demand deposits once that process takes place. And that's what I'm trying to get at here. It all depends on the question. You see the word initially, there's a reason for that, right? Or immediate, right? That tells you, okay, there's something going on here. It's kind of like in the last unit when we talk about the short run and the long run. Like I could change the answer to a question by writing in the short run or in the long run. Completely different answers, right? So what's going to happen to the long run, what's going to happen to inflation in the long run? You might end up with a completely different answer. Same thing with these. It's all about the wording, so be careful. Last one, assume customers withdraw more money from this bank than it has in reserves. So now we're assuming that someone's coming in and saying, listen, they only have a certain amount of money in reserves. I want $15,000, please, and they take their money out. What two options does this bank have to avoid becoming insolvent? In other words, what can they do to make sure they can give them their money because they don't have the money in reserves? Well, two different options. There's just several different things. The first one I'm not going to bother writing down is they can go ask these customer loans. They can go back to the people who they lent money to, car loans, whatever, and say, hey, listen, we need our money back. But they really can't do that because, right, there's a contract. It doesn't really work that way. So really, there's two ways they can do it. They can borrow from the Fed or the central bank. So they can borrow from the Fed, the lender of last resort, or they can borrow from what? Other banks. And that's going to lead us to the next concept we're going to talk about with the discount rate and the federal funds rate. So they can borrow from the Fed. They can, someone I saw in the chat, someone said they can take from their excess reserves. They totally can. I'm saying this person takes out more money than they have in excess and required reserves. And this is actually important. I think that's what I'm getting at. Watch. When you see this, when you see the word reserves, now this is important. When you see the word reserves, we're talking about both required and excess. So anytime you see a question that says, how much do they have in reserves? In fact, if I were to ask this question over again, right over here, what's the dollar value of the bank's required reserves after $10,000? I could have asked, what's the dollar value of the bank's just reserves? If I said that, then you'd have to add in the potential excess reserves. All right, that's important. Understand, when we talk about reserves, we're talking about both of them added together. I'm not sure if you're picking up on why this is important. Again, that's another factor that might change a question. If I say what's going to happen to the change in reserves, or what's going to happen to the change in required reserves, or I say what's going to happen to the change, in excess reserves, all those little tiny nuances matter. All right, that was the first page. I hope you felt comfortable in general with this concept. We started off with nominal and real interest rates. Then we moved on to bank balance sheets. This is not enough. If you're feeling at all uncomfortable, go ahead and watch that video where I have you practice bank balance sheets over and over again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. This is out of 11. So let me know right now, how'd you do at 11? In the comment section, let me know how you did out of 11. This is gonna help me organize my thoughts so I can help make better resources to help you learn as that comes in. You guys are leaving good comments, which I appreciate it. So I'm waiting for those to come in. As we wait for that, please start taking a look at the second page. We're going to talk about monetary policy, and we'll start jumping into loanable funds. Like I said, though, about bank balance sheets, there's several practice free responses on the AP test. The AP exam provides the free responses for free with all the answers, so you can get on there and practice some of them. On my website, if you haven't seen this, just click on students on acdcecon.com. You click on students, and then there's a free response page where you look on macro free responses, and it has them all organized by topic. So if you're looking for like a bank balance sheet free response, you can go in there, boom, search for it, go to like 2016 AP exam, question 3, get online, you can then download it. So that's what you can totally do. It looks like people are coming in 10 out of 11. Like I said, somebody asked about the monetary base idea. This is probably the only tricky one in the whole thing, is this idea of the monetary base. It's not something they've asked in the past, quite frankly. They changed the AP economics curriculum in the summer of 2019, and they specifically added this idea of the monetary base. And there's a few textbooks, like the Krugman textbook, that focuses on the monetary base. Just understand that any change in reserves is not part of the money supply. If you understand, that's fine. It is the money supply once they loan out that money. When that loan gets given out. So if I were to reword this question, stay with me. If I said right here, right here. No, I lied. Where is that one? Oh, assume instead the government buys $10,000 securities. Instead of saying immediate effect, if I said when the bank loans out their excess reserves, what will happen to the M1 money supply? Then you'd say it would increase. But again, it all depends on the question. I know I keep saying that, but it all depends on the question. It looks like people did well for the most part. 10s and 9s, which are awesome. And a lot of people are saying thank you, which I appreciate. Thank you so much. You can thank me, subscribe, and like. And let's move on to the next page. I hope you guys are ready for this. Let's do it. Really quick, let me go back to the unit overview super fast right here. I talked a little bit about financial assets. We'll talk about bond prices at the end of this next page. Nominal real interest rates, I covered both of those. Definition of money. I mean, this is more like just quick, 3 functions of money, understanding, M1, M2 money supply. Understand that, M1 money supply, the money supply we usually focus on this is just the easiest thing. This is, most liquid assets, your checking account, your checkable deposits and cash. Functions of money, banking, So for the most part, I've already done the first 4 of these. Now we're switching gears over to the money market and money supply and loanable funds. So let's go ahead and jump into that. All right. So first of all, I hope this is helpful. Let me know in the comment section if this is helping you guys learn. I have, like I said, this is designed for practice. I have a summary video for Unit 4 that goes in more details and all the other concepts I just quickly went over just right there. So we're back into here. This is the only thing, I think if someone didn't watch this video, they'd be probably pretty confused what I'm looking for in this chart up here. But I think at the same time, this is probably the most effective way to solidify these things in your brain, because you've learned long-run self-adjustments and fiscal policy back in Unit 3, and now here we're talking about monetary policy. So let me back up and just give you a quick overview. You already know this. Monetary policy is when the central bank adjusts the interest rates to stimulate the economy or to slow down the economy. So that's why over here, how does a decrease in interest rates affect investment? The key, most important relationship in all of macroeconomics is this idea of interest rates and investment. When interest rates go down, investment goes up. And the reason why I'm pointing this out, and I specifically wrote this question just to remind students what investment is. Investment is always 100% in this class, talk about borrowing. It's on the borrowing side. You're borrowing, taking out loans to buy machines, tools, and factories. This is business borrowing. So lower interest rate, and the reason why it says explain, this makes loans cheaper for borrowers. Now, the reason why this is important is because if you flip this and think of investment as lending, then you always get the exact opposite answers. So if the interest rate were to go down, well, I don't want to lend as much at a lower interest rate, and so investment would decrease. If you get that in your mindset, then you're just done for this entire class. This is the key. If you don't, and so I'm gonna write little hearts. If you've seen my unit video that talks about relationships, you know exactly what I'm talking about right now. But this is the key relationship that you absolutely need to know. If you don't get this, then you can't get monetary policy. And since we're here, I might as well answer this one. This goes back to what we just answered a few minutes ago. Remember we said earlier this bank could borrow from the Fed or the bank could borrow from other banks? That's the difference between the discount rate and the federal funds rate. The discount rate is the rate the Fed charges. So this is the rate that the Fed or the central bank charges these commercial banks. So if I need to borrow money, I'm a bank, I need to borrow money, I can go to the Fed, I pay the discount rate. The federal funds rate is the rate banks charge each other. Now, this is the worst misnomer of all time, ever of all. I mean, investment is probably one of the worst misnomers, but this one's horrible. The federal funds rate suggests, well, that should be to the, no, this is just what banks charge each other. So if Bank of America needs to take a loan from Wells Fargo, they're going to charge them a rate, and that rate is the federal funds rate. Now, this is a target rate that the Fed looks at when they're trying to make monetary policy decisions, and they try to lower interest rates. That's what we're talking about. Now, in real life, there's a lot more going on here than what you're actually learning in your class. Like we talked about, there's 3 shifters of the money supply. We talk about money supply. There's really, and I'm going to add it to this chart too, but understand there's reserve requirement, discount rate, open market operations. In fact, that's what this is all about. So I'm going to zoom in on this one. Again, if you don't, it says fill out this chart showing how each influences the economy. I just want you to understand, and the reason why I'm setting it up this way is if you can fill this out, you totally understand these different concepts. When there's a recessionary gap or a negative output gap, the long-run self-adjustment is wages are going to fall and resource prices fall. So when resource prices fall, that's going to cause the aggregate supply to increase. This is the idea that if we do nothing, no policy. In fact, I should have wrote that down. This is a self-adjustment means no policy whatsoever. Fiscal policy is, and when there's a recessionary gap, is an increase in government spending or a cut in taxes. This will increase aggregate demand. So we increase government spending or cut taxes. That's what's going on right now in the United States economy in 2020 is they're increasing government spending and they're trying to promote consumer spending with the CARES Act. Basically, they're trying to increase aggregate demand. For monetary policy, there's 3 different options that we're going to focus on for the AP test. They can lower the reserve requirement. They could lower the discount rate, which makes sense. They can lower the rate over here that the Fed charges. Or they could buy bonds. They, as the central bank, buy bonds. That's called open market operations. This would increase aggregate demand. Okay, the reason why I'm bringing this up, this is super important, is please remember that both fiscal policy and monetary policy both shift aggregate demand. Both of these cause aggregate demand to change. Long-run self-adjustments are the, I'm going to write short-run aggregate supply, cause the aggregate supply to shift. So if you're really thinking, what's the difference here? Well, there's a couple differences. One, this is doing nothing, and this is doing something. And if we're doing something, there's two different entities that can do it. This is the government, uses fiscal policy, central bank does monetary policy. And then the result is either over here, a change in aggregate supply, or over here, aggregate demand. And it happens both ways. So with both recessionary gap and inflationary gap, this is just all the opposite. When we have an inflationary gap, wages will eventually go up and resource prices go up. So aggregate supply, the short run aggregate supply will shift to the left and decrease. But notice it's aggregate supply that's shifting. Over here, you can decrease government spending, and you can increase taxes. That will cause aggregate demand to fall. That will decrease price level, bring down inflation. And over here, they can increase the reserve requirement. That was weird. They can increase the discount rate, or they can sell bonds. They, as in the central bank, can sell bonds. That'll cause aggregate demand to go down. That'll slow down the economy. Again, this hopefully, it doesn't seem like that's a big idea. That right there, just this chart, understanding what I just said, probably could get you the answer to 4 or 5 multiple choice questions on an AP test or your test, for your final exam, just because you understand these relationships. You understand each one of these individual things. The one thing I'm leaving out here is this term open market operations. Make sure you know that term. This is that buying bonds and selling bonds. I mean, I'm kind of doing some teaching here. I know I shouldn't. I know you guys know this stuff. You're here to practice. So let's go practice and do this. Let's, the application of all this that you're seeing right here is actually in this fear response that we're about to do right now. So we're going to go do this practice fear response. I'm skipping 4. I'll come back to it, I promise. We're going to do this for response because this is going to connect monetary policy with a key graph. Now, this is 2020. The AP test is not supposed to have a graph, so don't freak out. Be like, well, this is not on the test. If you can draw the graph and you understand the graph, then you can answer questions. One of the biggest mistakes I'm seeing from students is they're going, oh, cool, I don't have to learn the graphs because it's not on the AP test this year because COVID-19. I'm like, no, if you understand the graphs, you're going to be fine because you can use the graphs to get the right answer. So right now, we're going to go ahead and do this practice for response. Right now, this is from the 2017 AP exam. This is question number 2. I'm going to do this right now. Assume the economy is in long-run equilibrium. Assume that consumers wish to hold less money because they use credit cards more frequently to purchase goods and services rather than cash. Okay, let's make sure we understand. Credit cards are not money, right? You can use it to buy things, but it's a short-term loan, so it's not part of the money supply. So understand people are using something that's not part of the money supply for transactions, and so that's going to affect the supply and demand for money. In A, this is getting to the key graph that you have to be able to draw, and that's what I'm trying to get at here. Right now, if you didn't already do so, do it. I want you to draw the money market graph. Now, I'm going to give you some time to do that. As I talk about, there's 2 key graphs you got to know in this unit. There's loanable funds, which we'll do in a second, and there's the money market. This is the money market graph that you absolutely have to know. First thing you know is this is the nominal interest rate. That's what we're labeling up here. Down here is the quantity of money. All right. Then you have a downward sloping money demand curve and a vertical money supply curve. You could label this SM, that's fine either way, but just understand this is the money market. And you also have to finish it off over here with the interest rate. I'll write IR with 1 because we'll be changing that up. I need to ask down here too, this is the quantity of money, 1. Now, conceptually, you understand the idea. Let me just remind you, this demand curve is based on asset demand and transaction demand, the concept I talked about in the unit summary video. The supply of money is set by the central bank. And so this won't shift unless one of these 3 shifters from up here change. If there's a decrease in reserve requirement, discount rate of buying bonds, this supply curve does not change unless one of those 3 things change. So this is not changing reserve requirements. This is not discount rate. This is not open market operations. These are people holding less money because they're using credit cards. So what's happening on this one? Well, it says, draw correctly labeled money market graph, show the effect of reduced holding of money. This is a demand shift. Money demand, MD1, has now increased, so I'll draw an arrow. I'm sorry, decreased. So now this is the new interest rate. I'll put interest rate 2 right there. Notice the interest rate has now fallen. The nominal interest rate has fallen. Again, the reason why is people are holding less money, demand for money has fallen. Now, again, this year, the 2020 test, they won't ask a question, at least they're saying they don't have graphs, so you might not ask that, but they can still ask you questions about it. So they can say, okay, this occurred. What'll happen to the nominal interest rate? What'll happen? They'll ask you questions that if you have the graph, it's easier to figure that stuff out. So there we go. For this first part, let me pull out the answers really quick so we can see how many points things are worth. 1 point for correctly labeled money market graph, 1 point for showing that shift. So this was 2 points in A. Make sure you understood 2 points if you did this correctly. Keep track of your points so I can see how you guys actually did. In B, based on the change in interest rates in part A, what will happen to each of the following in the short run? Price of issued bonds, BI. I purposely gave you this question because I wanted to show you this idea. Right now, first of all, there's no explain. It's either up or down or not changed or indeterminate, I guess. So right now, write down your answer. Let me know in the chat, in the comments, what you think the answer is for this one. Price of previously issued bonds. The answer is bond prices will, what do you think? They're going to increase. Bond prices will increase, but doesn't require explanation, but you need to be able to explain it just in case this year they ask. Understand the idea when nominal interest rates fall, when interest rates go down, bond prices go up. They're inversely related, always, always, always. In the summary video, unit summary video, I explain the reason why. In fact, I totally go over the idea of understanding interest rates and bond prices. Just understand that bonds, these are bonds that have previously been issued. If the interest rate's lower, then people would prefer those old bonds. Those bonds have been issued, and so people want to pay more for them, so the price will go up. All right, that was the answer for that one. For 2, the price level and real income explain. So if interest rate goes down, right, this is going to lead to a chain of events, and this goes back all the way up here to the key relationship, which is investment. So if interest rates go down, that's going to cause investment to go up, and this is the idea of interest-sensitive spending. People who take out loans for cars, so consumer spending would go up too, business spending would go up, and this would increase aggregate demand, right? Which would cause the price level to increase and basically the income or real income, real GDP would go up. So you would write out, if I'm going quick here, the price level and real GDP would explain because lower interest rates mean more investment and increased aggregate demand. If that was what you wrote, that would be enough. I'm writing out this way. You probably don't want to leave it this way on the AP test just because, I like to write it out that way because it's simpler in my brain. But you want to write it out because it's your one chance of getting the points you deserve for the test. So that's what you're going to write out. You understand the idea. All right. In C. Now, technically in C, I'm bringing in a concept that's actually from Unit 5, and I'll write that in here. This is from Unit 5. You probably haven't covered this yet if this is where you are right now in your class, Unit 4. So question C is not something you can answer, but understand the idea. There's this concept you learn later on. It's this idea of the quantity theory of money. The amount of money that's out there times the velocity of that money equals the price times the GDP, the real GDP. So this equation that you learned in Unit 5, and again, I have a summary video for Unit 5. It's in the Ultimate Review Packet. It covers all this stuff. This right here on this side is the nominal GDP. It is the price of stuff, that's a P, times the real GDP. So that's the real GDP, by the way. And basically, we know nominal GDP is going to go up. Why? Because we already said it is right here. If the price level goes up and real GDP goes up, that means nominal GDP is going to go up. So this is going to go up. And the question says, with a constant money supply, so if this is constant, based on your answer in part B2, will the velocity of money increase, decrease, or remain the same? Well, if this stays the same and this increases, then something's got to go up. The velocity of money will increase. In fact, on this one, it didn't actually say any explanation. Just if you wrote that, velocity of money would increase. You don't want to write just V. Velocity of money, write it out, do it right, increase. All right, I'll put a D down here. If the central bank wishes to reverse the changes in interest rate identified in A, what open market operations should they use? Notice we're going back full circle to open market operations. This concept, make sure you know that term. It's the thing that's most asked by your professor or your teacher or the AP test, open market operations. The question is, if the interest rate is falling and the Fed's like, yeah, we don't want that to happen. We want to keep the interest rate the same, or we want to at least, slow down this falling. What can they do? Well, they can decrease that money supply. If the Fed decreases the money supply, I'm just going to draw it. You shouldn't, but I'm just going to draw it. If the Fed decreases that money supply, then interest rates won't actually end up falling. They'll stay somewhere around here, or they'll be indeterminate. So the answer is, what decreases the money supply? This is a tricky question, because you have to know, one, that they have to decrease the money supply. Then you have to know how they decrease the money supply, which goes back to this, right? And then you have to know, okay, well, what are they going to do? What's open market operations? And the idea is they sell bonds. Again, this didn't require explanation, but understand the idea down here. Selling bonds, this will decrease the money supply. Money supply will decrease. And understand that also the idea is when the Fed sells bonds, right? So if you go back to a bank balance sheet, when the Fed sells bonds, that means now, in fact, let's do that. If the Fed, let's go back to this. So I want you to understand conceptually the idea. When the Fed sells bonds, so let's say we're back to here and there's excess reserves of $10,000. Instead, let's do the opposite of what we did earlier. The Fed sells bonds. Okay, here's a bond, which is not money. This excess reserves would disappear if they sold $10,000. It would become government securities, we said, is a total of $11,000, and now they have less excess reserves. That's the idea of less money, right? Because now they loan out less money, and the money supply wouldn't decrease. The monetary base would, but now the bank can't loan that $10,000. That would decrease the money supply, which is what we're trying to say in the first place. Hopefully does that make sense? Hope it does. Right now, add up all your points for this one. So there was 2 points in B, another point in C, another point in D. Make sure you get points for the explaining. And notice this is out of 6 points. Again, this is from the 2017 AP exam. Right now, let me know how you did out of 6 points on that first response. If you're thinking like, oh man, this is easy, this is a joke, then you are up and running, man. You're totally ready. And if you're not, if you got like 1 out of 6, that's okay too. You got plenty of time to review. I have plenty of videos here on YouTube to help you out. Between YouTube and my Ultimate Review Packet, everything you need is totally in there. You're gonna be fine. All right, let me see how you guys did on that. It looks like you guys did good. So the last thing we're gonna do is something called loanable funds. So we're gonna jump into that. There's a key graph that goes into loanable funds. You have to know the graph. I'm waiting for you guys to let me know. Let me talk about loanable funds as your information's coming in about your scores. Loanable funds, I have videos that explain it. I've got, like I said, the unit summary video that goes into details. All you got to understand for loanable funds is this is, the supply and demand for loans, and we're looking at the real interest rate, not the nominal interest rate. So that's why over here we're talking about what's going to happen to the real interest rate. It's just a supply and demand graph. That's all it is. The one thing I want you to remember is demand for loanable funds is by investors. And investors are businesses. Remember, this is borrowers. So when I say the word investors, I'm talking about, this is borrowers. The supply is by lenders. Another word for lenders is savers. These are people who are, so again, what I'm writing here is the demand for loanable funds is generated by people who are borrowing money, and the supply is by people who are lending that money, which are savers. Same idea. People are saving that money. And that if you keep this in your brain, first of all, if you just keep this in your brain, these become super easy, because all you have to do is ask yourself, is this going to affect someone who's borrowing or affect somebody who's lending? And oh, by the way, when it comes to in loanable funds, there's always a lot of like double shifts that occur. So the AP test and your college professors for your responses, for the most part, will be very clear. They'll say, okay, what'll happen to the demand when this occurs? And you'll see what I'm talking about in a second, because a lot of times there are kind of double shifts that happen. All right. To decrease unemployment, the government deficit spends. We already have one that looks maybe potentially like a double shift. First of all, does this affect borrowers or lenders? We're going to focus on the borrower side. So this would be demand, and it would increase, and that would lead to a higher interest rate. Interest rate would go up. Now, when I said, listen to the wording. I want you to think what's happening in your brain right now. When I said the government deficit spends, that causes the demand for loanable funds to go up and the interest rate to go up, your brain right now should say 2 words. Say it with me, seriously. Say it out loud with me. 3, 2, 1, crowding out. Right now in your brain, when you saw that, that's the idea of crowding out. Crowding out is when the government borrows, right? And that leads to an increase in demand for loanable funds, increasing the interest rate. Now, this also could be explained using a decrease in the supply of loanable funds. And I explained, by the way, your teacher, by the way, might not have covered this yet either. This is explained over again in Unit 5, and I fully go over it in the unit summary video for Unit 5. So make sure you watch that. But just understand for now, this is the downside of fiscal policy we set up here. When government deficit spends, they increase spending and they cut taxes. That looks like it's all good, except the downside is that it could also lead to higher real interest rates, and that could lead to less investment. And less investment could actually slow down the economy, or at least, slow down growth of the economy. So that's the idea of crowding out. Crowding out. Do me a favor right now in the chat, right? Crowding out, right? Write it out so you can get it what I'm talking about. Political unrest causes foreigners to take money out of the economy. Now, political unrest would probably be a double shift. This is a good example that I mentioned earlier. This would affect both borrowers and lenders, but the way the question's worded, foreigners take money out, this would be a decrease in supply. So supply would decrease, there'd be less loanable funds available because there's less lenders putting money into the system, particularly foreign lenders, and so the real interest rate would increase, right? A decrease in supply, think of the supply and demand, supply decreases, the shift to the left. Again, this would be a lot easier to do if you drew out those graphs. I'm just doing this based on, I can draw the graph in my head. But if you're having a hard time connecting this and this, just draw out that graph. Supply demand, shift to supply to the left, interest rate goes up. All right, businesses expect lower sales and worse economic conditions. All right, remember, investing is businesses taking out loans, which we said kind of earlier. So this means less investment, which is a decrease in borrowing. So less borrowing, this is going to cause interest rates to go down. Lower real interest rates would fall. It also would affect lenders. I agree with that, but for now, let's just focus on one demand or supply shift. And last one, in anticipation of longer life expectancy, people save more. If people save more, that's going to lead to more supply of loanable funds because now there's more money available to borrow and to lend out to. So interest rates would go down because supply increased. Hopefully that makes sense. This right here, between these 4 different scenarios, you're pretty much going to get the majority of the questions that you're going to see on a free response inside one of those things. And I showed you all 4 different shifts. Remember, when it comes to demand and supply, there's only 4 things that can occur. Just remember this, keep it simple. Demand can go up, demand can go down, supply can go up, or supply can go down. That's it. Demand up, demand down, supply down. That's all that can happen. So I gave you all 4 of those in this scenario so you can see if it's the opposite of any one of these, then demand will go the other direction or supply will go the other direction. This, again, is this idea of loanable funds. I have videos that explain just the loanable funds market, have you draw that. It's something the AP test likes to ask a lot, and I mean a lot in graph form. We're going to see what happens here in 2020. Hopefully this helped you out. A lot of the concepts, particularly a lot of these concepts we did up here, I re-explain in Unit 5 over again. So we'll be back in Unit 5 next Wednesday to talk more about these concepts and other concepts that I'm leaving out, like the downsides of monetary policy. I'll spend more time talking about the money multiplier, the velocity of money, do some calculations with that. For now, make sure a couple things. Don't go anywhere. First thing I want to do is remind you, I know I sound like a broken record, and I do this because I have to. If you're a teacher, please don't give this worksheet out to your students in future years. I'm doing this to help out students here at COVID-19. So please don't, this is not something that I'm providing out for the world. So please don't use it. If you are interested, then see me about the Ultimate Review Packet. It's totally going to help you learn as students. Remember, there's an Ultimate Review Packet for AP Econ, Micro and Macro, AP Government, Calculus, AB, Human Geography, and World History. And there's more coming next year. So those will all help you learn. And the packet isn't just a PDF. And this is just the study guides and stuff that are printed out that are in there. It's a bunch of videos, a bunch of practice questions, it's practice tests, and all that stuff. If you're a teacher, please don't use any of those resources. Don't use that practice test. In fact, if you're a student and your teacher gives you a practice test, I got this from Mr. Clifford's Ultimate Review Packet. Say, no. You're not supposed to give that stuff out. And it says there on there as well. The next time I'm going to see you guys, it's going to be on Friday. Friday is going to be the case studies, case studies day. Case studies is the same sort of thing. I give you a practice sheet, but this one usually has an article or something like practical application economics. If you haven't seen them, go back and take a look at the ones I've already posted on Fridays. They're really awesome. What I want to do right now is I'm going to spend a few moments looking at some of your questions from the chat. So I don't want to take too long here, but I'm going to spend a few minutes. If you have questions, now is the time to ask. You might have questions about the monetary base or money supply or monetary policy. So now is the time to jump in there and let me know. Someone said stonks. That's not, I'm not going to talk about stonks. Someone said, I got 3 packets. They're so useful. I thank you so much. Like I said, I'm kind of stalling a little bit as you guys tell me what you want me to do. One thing I am getting a lot of emails about is students are like, hey, Mr. Clifford, are you going to do something for this year's I'm not sure why you talk like that as a student. Hey, Mr. Clifford, hey. But that's how I read it, I guess, in the email in my head. I am going to make videos very specific to this year's AP test for 2020. I'm going to do that because I want to help you guys out, but I'm not doing it now because we're not there yet. You know, I got May I can make videos like that for, and I'm going to go through different free responses they've given in the past and basically pull out sections, say, yeah, this is not something you'll see, and this is something you'll see. I'll also give you some resources like an equation sheet and some other stuff as well. So stay tuned to my YouTube channel. Can you give a shout out? I can, Gabriella. There's a shout out right there. For you guys that hung out this whole time, yes. Noah is here. You know, you guys are awesome. Jonah is here. Thank you so much for joining me. It looks like I'm going to be heading out here. You know, the most important concept I could possibly say this entire thing is just to practice. It's not any one thing that's hard. It's the practice that becomes hard. For the most part, you guys are just saying, hey, thanks, Mr. Clifford. So I want to thank you so much for watching my videos and, you know, basically for letting me be your online teacher this little bit, and it's been my pleasure to do so. As always, I finish off saying the same thing. I'll stay in the chat for a little bit, by the way, and answer some of your questions if you're interested. But it sounds like you guys are getting it. Thanks so much for watching my videos. You know what I'm going to say right now? I'm going to say until next time.